Hi, good afternoon if you're on the East Coast, and good morning if you're out west. This is Aaron Lacey. You're tuning in to the Higher Education Webinar Series brought to you by Thompson Coburn LLP. We're a law firm based in the Midwest, a pretty large law firm, several hundred attorneys, and do most things under the sun. But one of the things we pride ourselves on is our higher education practice. And we've been doing webinar series this year. And I'm sort of delighted and sad to say this is the last of our series for 18-19, but hope folks tuning in will come back for the 19-20 series as well, and we'll be putting out information about that in the coming months. So today we're talking about charitable giving, and specifically, you should see on your screen institutions of higher education as charitable donees. I will just real quickly show you the Higher Ed Webinar Series calendar and note that if you have missed any of these and you are interested, they are all available and on demand on our website and free. So if you missed one in the series and you want to go back, you are very welcome to do that. Our presenter today is Larry Katzenstein. Larry is someone I have known for, I guess, since I've been at the firm now, almost a decade. It says here in the second bullet that he is nationally known, and I think it is worth noting that that is really true. You know, you have a lot of attorneys who like to think that that's the case, but Larry is a guy who, in the area of charitable giving, works with all kinds of major entities and organizations from coast to coast and has for a really long time, and really knows his stuff. A couple of interesting facts in addition to what you see up on the screen. Some of you in the space may be familiar with the software Charitable, which is used by a lot of charitable organizations. Larry actually created that software. We were joking beforehand. He noted that he literally wrote, 70,000 lines of code?
Yep.
Yeah, so if you use Charitable, you're familiar with it. This is the guy who created it. Another thing I love about Larry that I think is just extraordinary and wonderful. Some of you know that St. Louis has the St. Louis Symphony, which is, I think, considered by many to be one of the premier symphonies in the United States, certainly by many in the city of St. Louis. And Larry conducts it about once a year, has that opportunity. And I can just tell you, they don't let just anyone take over the baton and conduct the St. Louis Symphony. And we always go. My family's been several times and always enjoy that opportunity. So one last thing just before I turn it over here to Larry to get started. There are a couple of housekeeping items, and I want to make sure to take care of that business. Like all the webinars in our series, this is CLE accredited, so that's continuing legal education. So if you're an attorney on the line, you can get CLE for tuning in today for, I think it's for an hour. You're going to see some polling questions throughout the presentation that pop up. They're not really questions. Basically, you just have to be sitting in front of your computer and click to show that you're still there. But please make sure to watch for those and to click, because that's how we know that you are there, and we ensure that we can get you your CLE credit. At the bottom of your screen, you're going to see several what we call widgets. All of these widgets are resizable and movable, so feel free to move them around and to expand, the slide area and manage things as you see fit. If you do have questions during the webcast, we have a lot of material to get through today. You can submit those questions through the Q&A widget at the bottom of the screen, and we'll try to get to questions to the extent we're able at the end. The last thing I really want to highlight here is Larry has put together a wonderful set of resources, a manuscript, if you will. We've got a lot of the information in the slides, but you'll see under that resource list widget, you can click on that and get access to his materials. And again, they're extensive, so please don't miss that opportunity. So with all of that having been said, I will turn it over to Larry.
Thank you, Aaron. As Aaron mentioned, I spend most of my time advising charitable organizations and philanthropists in the tax law charitable giving. And what I want to talk about today is a number of topics that are of current interest, and one topic which is broader than just current interest. And I can guarantee you that if you do some of the things I'm telling you, it will produce dollars in the door. And the main thing that I always encourage charities to do that they don't do is to monitor estates in which they are beneficiaries. That is especially important if you are the beneficiary of what we call the residue after the specific bequest. If, for example, the will says or the trust says, I leave the residue in my estate to X charity, you need to monitor those especially carefully. And the reason is not just to make sure you're getting what the document says you're getting, but to make certain that income taxes are not being paid unnecessarily and that estate taxes aren't being paid unnecessarily. And that happens not because anyone's trying to take advantage of you, but because these rules are so complicated and so few people who work with accounting firms and law firms even get these issues very often, that the rules are just not very well known. They're complicated, some of them are obscure, some of them don't make any sense, but if you really monitor these estates carefully, I can guarantee you that it will produce dollars in the door. Let me give you a simple example of one that I had last week for a national charity. This was a trust which said in Article 2, I give the following specific requests to charities. And it was 10% here, 20% there, 30% there. And then the residue also went to charities and to individuals. And the estate was taking the position that because they were called specific requests, they really weren't percentages. And that makes a difference because if it's a percentage of the residue, that means that we're entitled to income during administration and we're entitled to any appreciation. And it also may mean that no estate tax gets allocated to that share. So we convinced them finally that that was the case. But if the in-house attorney had not reviewed the documents and reviewed all the other documents that I'm going to suggest you also get, that would never have been picked up. So when you are the beneficiary of an estate, especially when you're the beneficiary of the residue of an estate, not only should you ask for the will of the trust, that's basic, but I would ask for the estate tax return if one was filed, and I would ask for any income tax returns that have been filed, as well as an accounting. You're entitled to those. You're entitled to review them to make certain you're getting what you're entitled to. And if you don't have those, you will never be able to pick up these mistakes, which again are not intentionally made. They're made because of inadvertence. So let me go through some of those basic rules with you. And let's start with the income tax rules and whether income taxes are being paid unnecessarily. So you can go to that next slide now. These rules are complicated because the rules are different from the rules that we are used to with individuals. For example, if I have a trust that has income and I distribute it, there are no percentage limitations. That's different from distributions to charity by individuals. There are other rules that make it different from the way other trusts are taxed. And if you don't monitor whether those rules are being followed, you may not get what you're entitled to. You'll see when we get a little further in the materials that if the residue goes to charity and the income is distributed currently, then it will be deductible by the trust. But here's the key point. If it can't be distributed currently, it may still be able to avoid income tax. First of all, if it's a probate estate, there's something called a charitable set-aside deduction. And if the income is accumulated in a probate estate and it's going to go to charity when the estate's closed, that income should not be taxed. Another thing that is often easy to forget is that if the income is accumulated not in a probate estate, but in a revocable trust, there is no set-aside deduction. However, there's an election in the tax law that allows a trust to be treated like a probate estate for income tax purposes. So if the primary document is a revocable trust, which is more often than not the case these days, if that income is being accumulated in the trust, you will end up having to pay income tax on that unless the trustee makes the election under what's called Code Section 645 to treat that like a probate estate for income tax purposes. So you have to monitor to make certain that those things are actually being done. Another thing that makes the taxation of trust complicated is that normally with trusts, if you distribute income, it's deductible as long as it's not a specific request. With a trust, though, it has to come from gross income if it's going to charity. If it's a distribution to individuals, it carries that income automatically. If it's a distribution to charity, it only carries that income if it actually comes from gross income. there's a tracing requirement, and that has to be documented. Otherwise, you will not be able to show that, in fact, this came from gross income. So what about the case where you have a substantial partial distribution? Again, you need to be able to show that that came from gross income. If I sell an asset to raise cash and I distribute the cash, that's not from gross income, even if it's a specific request. Another thing that makes this area complicated. If I make a distribution to an individual, it's deducted as a distribution deduction. If I make a distribution to charity, and for some reason it doesn't qualify as a charitable deduction, maybe because, for example, it's not from gross income, can I then deduct it as a distribution deduction? And the answer is no. I think the answer should be yes, but a whole bunch of cases going back to the Mott and O'Connor cases say that unless the distribution qualifies under 642C as a charitable deduction, you can't deduct it at all. Now, if you would ever have that issue, I think there's a good argument that those cases might come out a different way today. And the reason is that what they were worried about in those cases, Mott and O'Connor, which go 30, 40 years ago now, was the situation where in year one, I make my distribution out to my charitable beneficiaries, and then in year two, I terminate the trust and distribute what's left to the non-charitable beneficiaries, at which point all of the income's been washed out in the first distribution to the charities. That particular abuse that they were worried about, you can't do anymore. And the reason is that what we call the separate share rule did not apply to both trusts and estates in those days. It only applied to trusts. Now that it applies to estates as well, the abuse they're worried about there, you can't do anymore. So I hope you never have to litigate that issue, but if you do, I think there's an argument at least that if you don't qualify as a distribution to charity under 642C, you can still qualify as a distribution deduction. So what about this interesting issue? We will see when we get to the estate tax issues that if the estate is going to charity, but it bears estate tax, then you have to reduce the charitable deduction by the amount of the estate tax. Now, how could that happen? Well, it could happen, for example, where half the estate goes in specific requests to individuals, enough to generate estate tax, and the rest of the estate goes to charity, and the tax clause in the document says, pay estate tax out of the residue. And in that case, the tax law says you have to reduce the amount going to charity, the charitable deduction, by the estate tax because the charity is not getting the estate tax. It only gets what's left after the estate tax. And that causes a circular interrelated calculation because when you reduce the charitable deduction because you're paying estate tax out of it, that decreases the charitable deduction, that increases the estate tax, that further decreases the charitable deduction, which further increases the estate tax. So it very rapidly winds up being a very large number. Now, what about the case where income is going to charity, but income taxes are coming out of that income that's going to charity for a similar reason? Do you have to reduce the amount of your income tax charitable deduction by the amount of the income tax that the charity is not getting? And your first reaction would be, if you had not looked at this issue before, well, of course you've got to reduce the income tax deduction. Why should this be different than the estate tax rule? But surprisingly, there is a 1922 Supreme Court case right on point with a decision by Justice Oliver Wendell Holmes in which they said that the income tax deduction is not reduced by the income tax that comes out of it. And I love the one line in his opinion, quoting the Court of Appeals, he said, it can be fairly imputed to legislators that they could not have intended to require an interrelated algebraic computation, which always amused me. Didn't think the legislators were clever enough to think about that issue. Now, in the estate tax area, that has been changed many, many years ago by statute. So the estate tax charitable deduction does have to be reduced by estate tax. But the court in the Hartwood College case in 1986, I think it was, said, well, we've got a Supreme Court case right on point. It says you don't have to reduce the income tax deduction because income taxes are being paid out of it. And we've got a Supreme Court case that says that in the estate tax area, Congress changed the rule for estate tax purposes. They did not change the rule for income tax purposes. And so the Edwards v. Slocum case from the 1920s, Justice Oliver Wendell Holmes' opinion, controlled the day. I think that was a very interesting case, and that situation could come up surprisingly often. And I think most people would be surprised to find that that was the result. So before we go on to a couple of the other issues involving taxes, let me again just recap the 642C issue very briefly. If the estate is a probate estate and you're accumulating income because the probate estate residue is going to charity, if you can distribute the income currently, it's deductible as a distribution deduction to charity, as a charitable deduction. If you cannot distribute the income currently because the state tax return hasn't been audited yet, you want to wait till the claims period has gone by, all those sorts of very valid reasons why the estate may be around for several years. In that case, if you're accumulating income inside the estate, you should never be paying income tax on that because of the charitable set-aside deduction. If it's a revocable trust, which is the primary dispositive instrument, if you distribute the income currently, it will be a charitable deduction. If you cannot distribute the income currently, you cannot take the set-aside deduction because it's a trust unless the trustee makes the election under Section 645 to treat the trust like a probate estate for income tax purposes. And if that election is not made, you will not be able to avoid paying income tax on the income accumulated during distribution. You should never be paying income tax on that. And again, unless you monitor these things, you'll never know about it. So get copies of the income tax returns. Another issue that sometimes comes up, but I won't spend a lot of time on it, is in a case where you have a probate estate that is funding a charitable remainder trust. That would be a charitable remainder unit trust, a charitable remainder annuity trust, those vehicles that we use every day for charitable planning. And the problem here is some confusion that I won't go into any detail on, but especially if you have a delayed distribution from the estate itself may be subject to some of the private foundation rules that prohibit self-dealing. So I don't think that's worth spending a lot of time on, but just be very aware of those issues. Another question that comes up with funding of charitable remainder unit trust is whether that deferred funding, because the estate is still in administration, requires that the trust pay the payments out with interest to the beneficiary. And there's a dispute about that, and probably the safest thing is to pay interest on those. A final issue involving the funding of charitable remainder trust is whether when the estate terminates in favor of a charitable remainder trust, the income that's carried out qualifies for the charitable deduction or whether you have to take it as a distribution deduction. And there's some material in the outline. I think it does not qualify for a charitable deduction because the charitable remainder unit trust or annuity trust by definition is not an entirely charitable vehicle. Now, let's go to the next issue. And I have a case like this right now for a national charity, which is our estate taxes being allocated properly. And here is how the issue comes up with estate taxes. And I think you can go to the slide on estate taxes now. With estate taxes, the problem is that in many cases, the author of the instrument didn't think about the tax laws. You know, we're used to in the garden variety trust, which says that I have X amount of specific requests to individuals, 10,000 here, 20,000 there, and the residue goes to the residuary beneficiaries. The typical tax clause would say pay tax out of the residue because you don't want to decrease these specific requests. And many lawyers use a broad tax clause that says pay out of the residue without really thinking about it. So what happens in a case, and I've got one just like this now, where you have a will and it says, for example, that half of the residue goes to individuals and half of the residue goes to charity. And let's say that the tax clause simply says pay tax out of the residue without contribution. Does that mean that the charity has to bear part of the estate tax, which also means that you, as we saw before, will end up decreasing the charitable deduction and increasing the estate tax and going through this algebraic circle? Well, it doesn't necessarily mean that at all. Most states have doctrines called equitable apportionment. And what they say is that charities normally don't bear estate tax unless it's very clear that that's what was intended. So a broad tax clause may not be sufficient to put the tax burden on the charity. In most cases, courts will say you've got to be more specific than that. You've got to say, I really do intend for the charity to pay part of the estate tax, even though they don't generate any of the estate tax. Some states have what's called the Uniform Apportionment of Estate Tax law, and that uniform law says exactly that. It says that charities normally don't bear estate tax, and if you want the tax to be borne by the charity, the document has got to be very explicit about that. There are also federal statutes. For example, and this is a case I had a few years ago for a charity, a local charity in St. Louis. This was one where the will said all of the residue to charity. And it also had a tax clause which said pay all estate tax out of the residue. The problem was that the decedent also owned a large life insurance policy, includable in his estate, which was payable to his niece. And if the estate tax on the niece's insurance proceeds really got paid from the residue passing under his will, it would have wiped out the residue entirely. Well, there's a federal statute that's part of the Internal Revenue Code that says that insurance bears its own estate tax unless the will says the opposite. So if the insurance goes to an individual, code says it pays its own estate tax unless the will, the governing instrument, says that it doesn't. Here we had a broad tax clause, and what the Missouri court said was that broad tax clause is not enough to override the federal statute. If you really wanted the insurance to not pay any estate tax, you've got to say that and be specific that the charity does not bear the insurance. So if you're looking at a document that says pay tax out of the residue and part of the residue goes to charity, you've got a very good argument in most states that that is not enough to cause the charitable share to bear part of the estate tax because it wasn't specific and definitely shown by the testator that's what they intended. And again, it's usually because the testator didn't think about it. They used the same broad tax clause that they always use. There's this Uniform Act, which now more states have adopted. There is still not a majority, but it is probably maybe a quarter now have adopted. And that statute, if more states would adopt it, would solve this problem. I want to read you what the National Conference of Commissioners on Uniform State Laws said about this section of the Uniform Act. A decedent's direction will not control the apportionment of taxes unless it explicitly refers to the payment of an estate tax and is specific and unambiguous as to the direction it makes for that payment. For example, a testamentary direction that all debts and expenses and claims against me or my estate are to be paid out of the residue of my estate is not an express direction for the payment of estate taxes and will not control apportionment. The case I have now involves California. That's very clearly the law in California. They don't have the Uniform Act, but they have their own act, which says essentially that. Another reason you need to monitor estates is that there may be interests which pass to charity that don't qualify that could be fixed post-mortem if you do it in time. For example, you may be able to disclaim or have an individual disclaim an interest, which could cause a charitable remainder trust from qualifying. You may be able to use disclaimers to increase the charitable deduction. For example, if you have a charitable remainder trust created for two beneficiaries, a 50-year-old and an 85-year-old, because it's unlikely the 85-year-old is going to ever receive anything because they would have to survive the younger beneficiary, maybe the 85-year-old will be willing to disclaim that interest if it will greatly increase the amount going to charity. In addition, if you find you are the beneficiary of a charitable remainder trust that is defective, Section 2055E of the Internal Revenue Code has very broad, very generous, liberal provisions allowing reformation. It can even be used to reform trusts which were not even qualifying before 1969 by letting you get rid of interest which maybe would not let it qualify. Let me give you one example. Ever since 1969, if you have a trust that pays income to an individual, remainder to charity, the payment out has got to be either a unit trust interest or an annuity. Those are the famous charitable remainder unit trusts and charitable remainder annuity trusts. Well, even if you have a will that creates a charitable remainder trust that says pay income to X, remainder to charity, even that trust can be reformed if you do it within 9 months, even though that wouldn't have qualified ever since 1969. Notice as if the drafter went to sleep in 1968 and never saw that the new law had come into effect. Even that kind of trust with those gross defects can be reformed, again, if you know about it. And with some of these reformations that wouldn't have even qualified under the 69 Act, they've got to be done within 9 months after death. So the message there is make sure you monitor estates, make sure you get the income tax and the estate tax returns, and make sure that the instrument provides where estate taxes are being allocated in a way that is consistent with what the charitable interest is. Okay, having gone from that rather technical topic, let me go to some other topics which are less technical but equally important. And let's talk next about donor-advised funds. Want to go to the donor-advised fund slide? And this is an issue which has been creating vexing issues for a long time, and it deals with the fact that charitable pledges are created by many donors because charities like to be able to rely on them. And the IRS has always been a little bit inconsistent with the way it treats charitable pledges. On the one hand, if I make a promise to make a gift to charity in the future, either on my passing or later during my lifetime, I don't get a deduction when I make the pledge. I haven't parted with the money. I don't get a deduction at that point. On the other hand, when I die, the IRS treats that pledge as a debt deductible on my estate tax return, not as a charitable deduction, but as a debt deduction. And that can make actually a difference in some cases. The other thing about pledges is that even though it is legally binding under state law, if I satisfy that with appreciated property, that is not a realization event. You know, normally if I have appreciated property and I pay a debt with it, it's treated as if I sold the property, I realized the gain, and I gave the proceeds. But the service, going back to a 1955 published ruling, said that even if the pledge is a legally binding obligation under state law, one that the charity could sue me on, if I satisfied that with appreciated securities, that's not a realization event. I don't pick up income, and I can deduct the entire thing. Now, here's the issue that has come up with donor-advised funds and with private foundations. Let's say that I have made a binding pledge to make a gift to my favorite charity. And let's say that now I decide I'm just going to let my private foundation make that payment for me. Well, the IRS has taken the position for a long time that that's a self-dealing transaction. And if a private foundation makes a self-dealing transaction, such as paying my personal debt, there are very substantial penalties. It could lose the tax exemption. So for a long time, the IRS took the position, and it's still the current position, that payment of a binding charitable pledge by a private foundation is a self-dealing transaction. What about, though, the case where not my private foundation, but my donor advised fund is the vehicle I would like to use to make my charitable gift with? And here the service has not known quite what to do with it. Donor advised funds are public charities. They are not private foundations. So they are not subject to quite the same self-dealing stringent rules that we have with private foundations. Well, after studying this for some time, in 2017, the IRS came out with some proposed regulations, and most of them are not effective yet, but this one they said charities can rely on for the moment. And what they said in this ruling is that donor-advised funds can, in fact, pay a pledge of an individual as long as the sponsoring organization makes no reference to the pledge when they make the distribution, no donor or advisor indirectly or directly gets any benefit that's more than incidental, and the donor advisor does not attempt to claim a charitable contribution deduction. Now that obviously makes sense. They got a deduction when they put the money in the donor advised fund. So this is being called in the tax world, don't ask, don't tell. The charity, the donor advised fund can't reference the existence of the pledge. Doesn't say they can't know about it, but they can't reference it when they make the distribution to the charity. Getting that pledge relieved is between the donor and the charity that's getting the distribution, not the donor advised fund and the charity. So I think this is a good practical solution. I think what would be even better would just be to say that donor advised funds without any problem can pay these binding pledges. One of the problems that I think is a result here is that most donors, when they make a charitable pledge, don't even think about the fact that they can't pay from their donor advised fund. It's totally innocent. It's not an abuse, really, that I can see if I make a pledge to make a gift to a charity and then have my donor advised fund pay it. It's hard to see what the abuse really there is. I know technically I'm being relieved of a legal obligation, but I can't get too excited about that. That's not the kind of abuse that gets me excited. So I hope that the service will even liberalize these rules a little further. Now, one thing that they are not willing to do is extend the same rule to private foundations, because private foundations are under the control of the donor. And another thing they're not willing to do, even with donor-advised funds, and I think this is unfortunate, is what's called bifurcation. Let's say, for example, that I am invited to go to a charity dinner, and the ticket's $1,000, and the charity will tell me, well, the cost of the meal is $100, you can deduct $900. Well, what I'd really like to do there is have my donor advised fund pay the $900, and then I'll write a separate check out of my own funds for the $100 for the dinner. And the IRS says that is not permissible. And the theory is that I wouldn't be able to make the $100 gift except for the $900 gift, and that therefore that's an abuse. I don't see that as an abuse myself, and especially as we'll see when we get to donors over 70 and a half that are using their IRAs to make their charitable contributions, they will get no benefit at all from their $1,000 contribution to the charity dinner. One final thing I would say about charitable pledges in general, a lot of charities are getting away from using them at all because of these problems. You know, donors find that they later can't use their private foundation to pay off their pledge, which is annoying to the donors, and then you go through loops to try to get rid of it. And the fact is that most charities are not going to sue in the charitable pledge anyway if the donor doesn't pay. They're going to look at the publicity effects and whether enforcing this charitable pledge is really worth the publicity that could arise from it. So I don't think the fact that the pledge is not legally binding in most cases makes much difference. Now, if the charity is using the pledges to borrow money to go to a bank to get funds to build a building, that might be a different story. But in the garden variety case, I think these create more problems than they solve. So many charities, including some large national charities, are generally avoiding use of charitable pledges, knowing that most donors are going to make the gift anyway, that they're not going to sue if they don't in most cases, and that it just creates problems from their donor's standpoint when they find they can't pay it from the private foundations. But at least with donor advised funds, we now have some flexibility, and the proposed regulations, which I hope will be even liberalized a little further when they become final, will solve this problem. Let's talk next about the 2017 tax legislation and some of the ways that it affects charitable giving. And it's a very major change. None of the provisions primarily have the effect of affecting the charitable contribution directly, but they do affect what donors' behavior will be. The main thing that it has done that affects charitable giving is by eliminating most itemized deductions. For example, state and local property and income taxes are capped at $10,000. That's $10,000 even for an individual that is married. They have capped the indebtedness that can be deducted with interest on a home mortgage. If it's more than $750,000 in indebtedness, the interest attributable to that excess is not deductible. And home improvement mortgages, you can't deduct that interest at all now. Now, they did grandfather previously existing mortgages, but on any new ones, that won't be the case. And when you couple the fact that most of these deductions have gone away, including a whole slew of others, such as investment advisory fees, and when you couple that with the fact that the standard deduction is now raised to $24,000 for a married couple and over $26,000 for a married couple over 65, that means that most people are not going to be itemizing. So that affects charitable giving very directly. There are some things that donors are doing to take advantage of some of the ways that maybe they can deduct their charitable contributions anyway. One thing that a lot of people are doing is bunching charitable gifts. So maybe go to your charity and say, I want to prepay my annual gifts for the next 3 or 4 years now, so that will push me above the threshold when I can itemize. And if you go to the charity and say, I want to prepay my annual gift for the next 4 years, I can guarantee you all of you charities will accept that offer. Another way the charities are doing the donors are doing the same thing is by creating donor advised funds. You know, you put a lot of money in a donor advised fund with Fidelity or with Vanguard. The administration expenses are very reasonable, and then you make your annual contributions to charities over the several years using that fund. But because you bunch that deduction into 1 year, maybe that pushes you above the threshold where the donor can actually itemize. The other thing that I'm reminding all of our charitable clients who have planned giving offices is that when you're talking about some of the charitable giving vehicles that we've been telling our donors about for years, emphasize some of the non-tax benefits of these vehicles. And let me give you an example of that. We all know how charitable remainder trusts work. I put money in a charitable remainder unit trust, and I take back a 5 or 6% return every year. The remainder goes to charity. When I do that, I get an income tax deduction for the actuarial value of the remainder. So often in the past, charities have emphasized the income tax deduction and the fact that you're getting the estate tax benefit. But because the estate tax exemption is now so high, over $22 million for a married couple, and because so many people are not itemizing anymore, those income tax benefits will not mean very much. But what charities can continue to emphasize is that there are non-tax benefits from charitable remainder trusts. For example, let's say I'm leaving part of my estate to charity anyway when I die. Why not take my highly appreciated securities that maybe pay a 1 or 2% dividend, put them in a charitable remainder trust now? I can sell them. The trust is tax exempt. I won't pay any income tax on that sale of the securities. And now I've avoided the income tax on the sale of the securities. I've increased my income from 1% to maybe 5 or 6%. And all of those are tremendous benefits, even apart from any income tax deduction. So one thing that the new tax law, I think, has gotten charities to focus more on is some of the non-tax benefits of some of these charitable vehicles. The same thing would be true with charitable gift annuities. You know, charitable gift annuity payout rates can be pretty high at advanced stages, and if you follow the American Council on Gift Annuity Rates, even at those high payout rates, you should be pretty secure that there will be plenty left over for the charity. If you can show a donor that rather than leave an amount to charity at death, why not do it through a charitable gift annuity where they get back a substantial return now that is assured for a lifetime, assuming that the charity has the resources to back the annuity. And if they don't have the resources to back the annuity, they shouldn't be issuing annuities. But major charities with gift annuity programs can tell their donors, this is so much better for you because of the lifetime benefits and even apart from the income tax benefits. Another thing that becomes particularly attractive under the new law is the IRA charitable rollover. And the way that works is if the donor is over 70 and a half, so that the donor is having to take distributions from his IRA, the donor can have up to $100,000 of that IRA go directly to charity, and it doesn't appear at all in the donor's income. And so if you think about it, getting the income in and then giving it back out is a wash. So it's just as if they got the income, then gave it away and could deduct it. But it's better than that because not only now can they have this income going directly to charity and have it not be in their taxable income, but in addition, they can take the standard deduction, which, as we saw before, is $24,000 for a married couple. So anybody over 70 and a half who is now having to take distributions from their IRA ought to be using their IRA for their charitable contributions. It's so easy to do. You just tell your IRA custodian, cut these checks for me, send them directly to the charity, or send the checks payable to the charity to me, I'll send them to the charity. And some charities that have been promoting this are even reminding donors that many IRA custodians now give the donor an IRA charitable checkbook, so the donor can write checks directly from the IRA directly to charity and have that income go directly to charity and won't appear at all in the donor's income. That becomes even more important now with the fact that many donors will not be itemizing. A couple of other things in the new tax law just to caution you about. One is that there is a new percentage limitation. The percentage limitation for gifts of cash to a public charity have always been 50% for many, many years. The new tax law raised that to 60%. However, and there's always a however in tax law, that 60% may not be available because of a drafting error if the donor made any contributions which were not cash contributions in the same year, even if it was depreciated property. So let's say I have stock that went down, I gave it to charity in the same year. The way the statute is written, it appears that the 60% limitation is not available. So at least the way the law is written, if the donor makes cash contributions to charity, but has even $1 of a non-cash contribution to charity, the 60% percentage limitation is not available. The Joint Committee on Taxation recognizes that this was a mistake. I think it will get fixed whenever we get technical corrections. The bill was written very quickly. A lot of midnight oil was burned drafting this, and so there are a lot of technical mistakes like this that will be fixed. This may be the first Technical Corrections Act in history that's longer than the act is correcting. One final thing, and I'll mention it only because it's interesting and it affects higher education particularly, which is what they did with schools that have winning football teams. And this was the provision that has had a long history. And what the service got concerned about a bunch of years ago was situations where you have a school where it's really hard to get football tickets because it's such a great team. And you give a lot of money to the university, that didn't get you tickets. It got you on the coveted list of people who could buy the tickets. And so Congress got upset about that, and they passed a law saying, well, you can only deduct half of that. And then later they changed it to say, well, you can deduct 80% of it. Well, now you can't deduct it at all. They got rid of that. This is not a problem at many universities, but I went to Washington University. Getting football tickets was not difficult there. But for institutions where that's an issue, they'll have to find another way for their donors to get football tickets. There are a few other things in the new tax law that are probably not worth a lot of discussion. The one thing that I think affects higher education in some cases in a very unfortunate way, and I sure hope we can get this repealed, is the 1.4% excise tax on the net investment income of private college and universities with more than 500 students, more than half of whom are located in the United States, and where they have assets at least $500,000 per student. This does not affect just the Harvards and Yales of the world. For example, it affects schools like Amherst and Swarthmore and Grinnell and Williams, not the mega institutions, but schools that have been around a long time and have substantial endowments. Incidentally, the way the statute was originally written was the way I quoted it, a school with more than 500 students. That got changed at the last minute to say tuition-paying students. That was done for the benefit of Berea College, which is located in Kentucky. And where is the majority leader from? What state is he from? Kentucky, as I remember. So I think that's probably not an accident, although that exception may make sense there. So that's what I would say about the new tax law. There's one other thing that affects not just the educational organizations, but all the other charities, which is some excise tax on excess compensation for certain covered employees of exempt organizations. Let me go on and talk next about the final substantiation and reporting rules for charitable contributions. There are cases every year where donors don't get charitable deductions they should have gotten because of failure to comply with the qualified appraisal rules. And those qualified appraisals are required anytime a donor gives a gift to charity of something that's not cash or marketable securities of more than $5,000. Now, to be technical, the rule is not that you need an appraisal if you give something more than $5,000 that's not cash or securities. It's if you want to deduct more than $5,000. So if I have something that's worth $6,000 and I don't want to bother to get an appraisal because it's going to be too expensive, if I'm willing to limit my deduction to $5,000, then I can do without the appraisal. But those appraisal rules are really complicated. The final regulations go into some detail about some of the changes that have been made, but a couple of them are really worth remembering. One of them is that if I give a gift to charity of an object, which is not cash or marketable securities, it could be tangible property such as a painting, it could be real estate, I need a qualified appraisal. And if it's a gift and I want to deduct more than $500,000, I actually have to attach the appraisal to the return. Now, here's the thing that I think a lot of donors forget about. Let's say that my gift is so large that I can't deduct it all, and I have carryovers to the following years. I'm required to attach the appraisal even to those carryover years. That is very easy to forget. And if you don't attach it, you will not get your deduction for those carryover years. So that's very important. Keep that in mind when you have very large contributions. The qualified appraisal rules have been changed in some ways. I won't go into details because we have a lot of other things to recover. But remember that the qualified appraiser has to meet certain very specific requirements. And there was a very sad case a few years ago where someone lost a substantial deduction even though the qualified appraiser met all the requirements. And the problem was that the donor was the qualified appraiser. Well, the donor can't appraise his own gift, even though the donor is a qualified appraiser. So be very aware of those rules. Let's go to a couple other things quickly. I want to mention just one thing very quickly. You can look at it in more detail in the materials. And that's the situation when your institution drafts a charitable member unit trust for a donor at the very end of the year. Because of some abuses that clever lawyers thought of a number of years ago, if you fund a charitable member trust near the end of the year with a gift of appreciated property, and you don't get around to making the distribution out to the beneficiary for that stub period before the end of the year, then there's some very complicated steps you've got to go through. It's a deemed realization of gain. It's treated as if you sold some of the property and had gained and gave away the proceeds, then back to the donor. There's an easy way to avoid that by creating what's called a flip unit trust. A flip unit trust is simply one that pays income only, and then starting with the beginning of the next year, it becomes a regular unit trust. And those kind of trusts are not subject to these rules. So whenever we do a charitable major trust at the end of the year and fund it with appreciated securities, we do it as a flip unit trust. Then you don't have to, it's an accounting nightmare of having to have this deemed realization of gain. So it's a very good thing to practice. And that's especially popular at universities because often there's nobody really active in the planned giving office the last week or two of the year when donors suddenly decide they need to get their charitable gift done. So let's go next to some observations on planning gifts of tangible personal property. And I just have a few things to say about that, and then we'll try to leave a few minutes for questions at the end. The rules on gifts of tangible personal property are really complicated. And the first rule to keep in mind is that if someone gives a gift of tangible property to a charity, and by tangible property I mean physical objects, artwork, jewelry, musical instruments, those kinds of objects, the donor is limited to the lower of cost or fair market value unless the property is of the kind that the charity will actually use in its exempt purpose. So if I give a painting to a museum and it will actually display it, I can deduct full fair market value. If they can't use this painting, it's not museum quality and they're going to sell it, then I'm limited to my cost basis. The charity is required to report to the IRS any sale of that property made within 3 years. So the IRS will know that the charity wasn't able to use it. So no deduction will be available there in those cases except for basis. Now, another trap with gifts of property. Let's say that I bought a painting from the artist years ago, and I own the copyright, and I own the painting, and I give the painting to charity, and the deed of sale is silent about the copyright. Well, under current law, that means I've kept the copyright, and I have created a split interest gift, and no deduction is available. And just to show you how strange these rules are, there's a different rule for estate tax purposes. There's a provision in Section 2055 which says that for estate tax purposes, art and copyrights in art are separate property interests. So watch that trap. Another trap with tangible personal property is this. We often have charities that do auctions. And if I give a tangible object to a charity for an auction, I may think I can deduct the full fair market value, but remember, that's going to be sold. It's not going to be used by the charity in connection with exempt purposes. One place that really comes up often is with charities that have auctions and someone gives a valuable case of wine that's been in their cellar for 30 years. It's a valuable case of French wine. They paid a few bucks for it years ago. Now it's worth a fortune. That donor is limited to cost basis. Not going to be used by the charity in the way that's related to tax exempt purpose. And it's important that donors know about those rules so they're not disappointed later when they find that they can't deduct what they expected to deduct. The final thing I would say about gifts of art is that since 2006, we've had very complicated rules on fractional interest gifts of art. Why would someone give away a fraction of a painting? Well, it may be because the painting is so valuable that I can't use all my deduction, and I'm going to have a lot of carryovers, so I may not even be able to use all the deduction with the carryover years. So what I'd really like to do is give a tenth of it this year, give another tenth of it in a couple of years when I can use the deduction, give another tenth of the painting a few years later. And what Congress got worried about here was that some charities were never getting the rest of the artwork. And in fact, in many cases, we're not even displaying the art for the fraction of the year they were entitled to own possession of the painting. And so Senator Grassley got very upset about this, and in 2006, the tax law was amended so that if I give a fractional interest gift of art, I've got to make all my rest of my fractional interest gifts within 10 years or earlier by my death. And one thing that's unfortunate the way this is written is that if I make a fractional interest gift of art in year one, and then let's say 5 years goes by and I want to give them the rest of my painting, my deduction for that second gift is of a fraction of the value of the painting at the time of the first gift. So if there's appreciation in the art during that 5-year period, I don't get the benefit of that. I think that's unfortunate. This has really cut down on fractional interest gifts of art to museums. And those have been very valuable. You know, the museums like to have possession part of the year, and donors like to have museum have possession because it enhances the value of maybe their other work in their collection. So this is something that we'll keep an eye on. I think there's some chance that these rules could be liberalized. And we'll have to stop there. We have 5 minutes, but I've left for questions. I know we covered a lot in a short time.
Larry, thank you so much. Just really tremendous. I want to encourage folks again, just a reminder that there are some really superb written materials that Larry's made available that you can pick up just by clicking over on the resource materials. If for some reason you can't find those, or you don't locate them, or you can't get them downloaded, or something along those lines, look, just let us know, and we'll provide you with a copy. Speaking of resources, just a reminder again that we do have our Education blog, which is our higher ed blog, where we post things regularly. Maybe if I twist Larry's arm, I'll get him to post a blog or two. And our webinars are available on demand. So if, like me, this was a lot of material to absorb, Larry, your command is incredible. Mine is not there. So you may be like me and need to go back and listen again. You can do that. We'll have this posted usually within about 24 hours, and that way you can focus in on the areas in which you might have particular interest. We do have some questions, so I'm going to ask these to you, Larry, and see what you think. First, what is the most common problem you see in administration of estates that charities should be on the lookout for?
I think the single most common problem is tax clauses that weren't written with the realization that the way they're written could cause part of the residue going to charity to bear tax, and it just wasn't thought of whether that was intended or not. Ambiguous tax clauses, I think, is the number one.
Got it. Here's another one. Are there? Oh, this is interesting. So, are there some gifts charities should not accept?
Yeah, I get very worried when charities are approached with gifts of, say, a condo in California, and they've never heard of the donor before. There's no history with the donor. Is this really property that is going to be worth the time and effort to sell? Because in the meantime, the charity is going to be paying real estate taxes. Are there environmental issues? And that's why they're giving it to the charity. You really have to do your due diligence before you accept some of those gifts. And some of them, I've represented charities, we decided just to turn down a gift. It was not going to be worth the hassle of maintaining this property and trying to sell it, often in cases where the donor has not been able to sell it.
So it seems like it would make sense for colleges, universities, and their plain giving offices to have some sort of protocols or some process for really evaluating a potential gift before they decide to accept it.
Absolutely. And large charities have a real estate department. Yeah. And they can do some of that due diligence too.
Yeah. All right, we have one more. Should we start a gift annuity program?
I think gift annuities are wonderful programs to introduce donors to planned giving. My only cautions are that you have to have a large enough pool so that actuarially it works out. You know, if you have two donors and they both live to 110, your program won't be very successful. If you think you can get a mass of maybe 50 or 75 donors, then I think it's very worthwhile doing. Those actuarial tables are set so that on average about half of each gift will be left ultimately for the charity.
Got it. And we had one more question come in actually while you were answering. We have a lot of charitable remainder trusts which are separately invested. Can we pool these for investment purposes with our endowment?
There are a number of private letter rulings, and I've gotten several of them that allow pooling of charitable remainder trusts with the endowment. The big problem is insulating them from unrelated business income. Most large charities will have unrelated business income in their endowment, and we have to isolate those. And the way you do it is by saying that the unit trust doesn't get a percentage of the endowment performance. They get a contractual right to a dollar amount based on performance. And the service has blessed that. And it is a way of investing charitable remainder trusts with the endowment. One bad thing about it is the way it's structured, that means that all the income is going to be ordinary income. But if the endowment really does well, and donors may be attracted to that, in some cases it will be worth doing. But you can't do it without your own private letter rule.
Got it. Larry, thank you again. I really appreciate you being part of the series. I just want to remind folks again, this is the last one in our 1819 series this year, but we hope to put out information. We're working right now with some of the other attorneys here at the firm and thinking about the program for next year. Again, we'll run it from August to May, sort of along with the school year, so we'll be putting out materials probably in July that'll let you know when that is going to be and what we think the program's going to look like. If you have additional questions for Larry, if you have technical questions about the webinar, any of those kinds of things, always please feel free to reach out to us. We're very happy to help out. And again, I know I've said it several times. I'll plug it one more time. Don't forget to get those written materials that are available on the resource list, or to ask for them if for some reason you can't find them. Thanks so much to everybody. Have a great afternoon and a great summer. Keep a watch out. We may actually do some one-off webinars this summer. The Department of Education and other agencies have some new rules coming out. I think we may do a couple of things on cybersecurity. But otherwise, if we don't hear you again until August, be well, and we'll see you then.